everyone, I'm your host CA Neeraj. Welcome to my YouTube channel Accounting Buddy. In business, various unique accounting terms are used. These terms are standard accounting terms which are used universally. Understanding these standard accounting terms makes business communication easy and it also facilitates reading of financial statements. In this chapter, we will learn 30 plus accounting terms with examples followed by Q&A section at the end of this chapter. The first term which we are going to learn is business transaction. Business transaction term we have briefly discussed in our chapter number 1. Let us now understand the characteristics of a business transaction. There must be two or more parties. It must involve exchange of goods, services or cash among the parties. The transaction must be measurable in terms of money. It has an impact on the financial statements of the business, that is, it must trigger an accounting transaction. Let us now understand the term business transaction with an example. 5 transactions displayed on your screen are the examples of business transactions. Now, if we analyze the transaction of purchase of goods from vendor displayed on your screen, there are two parties involved, business and vendor. There is an exchange of goods and money between the vendor and the business. The transaction is measurable in monetary terms. Business made payment to the vendor and the vendor supplied the goods to the business. This transaction has financial impact, which is inventory has increased and the cash of the business has reduced, and the entry will be passed in the books of accounts. Therefore, in this example and in all the other 4 examples displayed on your screen, all the basic conditions of a business transaction are fulfilled. Therefore, we can conclude that a business transaction is an economic event that involves the exchange of goods, services, or funds between the two parties and has a financial impact on the business. These transactions are measurable in monetary terms and are recorded in the books of accounts. A business transaction can be classified into cash transaction and credit transaction. A business transaction is referred to as cash transaction when a transaction is settled immediately as soon as it is entered. In the example displayed on your screens, stationery and payment exchange hands at the same time. This and all other such transactions are referred to as cash transactions. A cash transaction is when you purchase now and you pay now. A credit transaction is when both the parties agree to settle the business transaction at a future date. In the same earlier stationery purchase transaction, if Mr. X and the shopkeeper agrees to settle the transaction after 15 days of purchase, it is a credit transaction. Therefore, a transaction is a credit transaction if you purchase now and pay later. Now, a business transaction could be external or internal. An external transaction is between two separate business entities or individuals which involves exchange of goods, services or funds. For example, company A sells goods to company B and company B makes the payment to company A. This is an example of external transaction. Now the internal transaction. As the name indicates, such transactions does not involve any outside second party. Such transactions are the result of the business events occurring in the normal course of the business. For example, the periodical transaction of depreciation on fixed assets. Depreciation is the wear and tear of the fixed assets due to its usage. We will discuss the term depreciation in detail in our subsequent slides. Second term which we are going to learn is the term account. Account is a summarized record of all business transactions related to a particular head at one place. Now this is an account for office rent, which summarizes all the transactions of office rent together at one place. An account is a record in the ledger, and transactions are sorted and stored separately for assets, liabilities, equity, revenue, and expenses. Therefore, we can conclude that an account keeps a systematic track of each category of financial transactions and ensures financial information is organized and summarized. Now the accounts can be categorized into five types: asset accounts, liability accounts, equity accounts, revenue accounts, and expense accounts. Asset accounts includes cash and inventory. Liability accounts includes accounts payable, loans. Equity accounts include capital and retained earnings. Revenue account includes sales revenue and the service revenue. The expense accounts include rent, salary, electricity, and other business expenses. The next term which we are going to discuss now is the term capital. It is a part of the money required to start a business which is invested by the owners or partners or other legal entities. I hope you remember type of businesses we discussed in chapter 1, Introduction to Accounting. In case of sole trader business, money is invested by the single owner known as proprietor. In partnership business, money is invested by all the partners. And in case of a company, money is invested by several shareholders. Capital invested can either be in the form of money or in kind, having a monetary value. As business is considered a separate legal entity, the amount of capital invested is considered as the money owed by the business to the individuals or other legal entities who have contributed money in the business. Several people who contributes towards the capital of the company are called shareholders. Remember, capital is also known as owner's equity or net worth. And always remember the accounting equation: capital is equal to assets minus liabilities. Let us understand this with an example. To start a food home delivery business, Mr. X and Mr. Y need total funds of say $25,000. Mr. X invested $20,000 in cash while Mr. Y gave four motorbikes worth $5,000 for the use of the business. In this example, we can say that the capital contributed by Mr. X is $20,000 and the capital contributed by Mr. Y is $5,000. Capital is shown under the head equity in the balance sheet. The term number 4 which we are going to discuss now is the term drawings. The term drawings refers to the amount of money or the value of goods taken by the owners of the business for their personal use. Drawings in cash or kind reduces the capital of the owners. For example, Mr. X has invested an amount of $20,000 in his business and he took $1,000 as cash from the business for his personal use. This withdrawal amount of $1,000 will get reduced from his capital in the business and the balance amount of capital will appear in the balance sheet. Drawing transactions are generally happens in proprietary and partnership form of business entities. Therefore, proprietor or partner's capital account is shown net of drawings in the balance sheet. The term number 5 which we are going to learn now is the term asset. Assets are the property owned and controlled by the business. Therefore, a property which by its basic nature is a asset, but if it is taken on rent by the business, it cannot be considered as the asset of the business. An asset will always have a monetary value. That is how it is recorded in the books of accounts of the business. As the owner of the assets, business has the legal right to use the assets during its useful life. Basis above pointers, let us list down the characteristics of an asset. Number 1, an asset should be owned by the business. Number 2, asset should have some monetary value attached to it. Number 3, The asset may be physically available like plant and machinery, or it might not have a physical existence like an accounting software. An asset is expected to generate economic benefits to the business in the form of revenue or cost saving now or in the future. Assets can be classified as current assets and non-current assets. Let us discuss current assets in detail. Current assets are held by the business for a shorter period, generally less than 1 year. Current assets are held for a short period as the purpose is to resell and convert them into cash or consume them to manufacture or process finished goods which are meant for sale. For example, in case of a trading business, when goods are purchased, there can be below business situations. Situation number one, there might be unsold stock of the goods. The value of unsold stock is classified as current assets. Situation number two, when goods are sold for cash, business generates cash and stock is reduced. Cash in hand is also a current asset. Situation number three, if the goods are sold on 30 days credit, stock will become less and the business will have trade receivables outstanding. The trade receivables are also current assets. There are certain current assets which cannot be converted into cash. For example, prepaid expenses. Prepaid expenses means the amount paid in advance for the future periods. Such amounts are classified as current assets. To sum up, stock in hand, cash, trade receivables, and prepaid expenses are some of the examples of current assets. Unlike current assets, non-current assets are not held for resale. Primary objective of holding non-current assets is to facilitate business operations, and occasionally they are also held as business investments. Non-current assets are held for a longer period, that is for more than 1 year, and they are held till the useful life of the non-current assets expires. Fixed assets acquired by the business are always non-current assets. Fixed assets facilitates business operations and enhances the earning capacity of the business. Fixed assets can be classified into two types, tangible fixed assets and intangible fixed assets. Tangible fixed assets can be seen and touched. Examples of tangible fixed assets are land, building. Intangible fixed assets do not have physical existence. Examples of intangible assets are computer softwares, goodwill, and trademark. The term goodwill and trademark will be explained to you in the subsequent chapters. There are certain accounts which are classified as fictitious assets in the balance sheet. Such assets are of no benefit to the business. They are neither tangible nor intangible in nature. They appear in the balance sheet as a part of accounting scenario. Accumulated business losses and deferred revenue expenditure are few examples of fictitious assets. Term number six, which we are going to learn now, is the term liabilities. The amount of money which the business owes to others is called the liability of the business. Now, if the business owes the money to its owners, it is an internal liability, while the amount which the business owes to the outsiders is termed as the external liability. Examples of business liabilities are bank loan taken by the business remains a liability of the business till it is not paid. Similarly, the goods purchased by the business on credit is another example of business liability till it is outstanding. Liability could either be non-current liability or a current liability. Non-current liability is the one which is payable by the business after 1 year and beyond. Bank term loan payable in 5 years is an example of non-current liability. Now the liabilities which are payable within 1 year from the end of the accounting period are current liabilities. For example, an amount outstanding at the end of the accounting period which is payable to the supplier, say within 30 days from the end of the accounting period, is considered as the current liability for that accounting period. Let us now try and answer few questions related to the terms which we have learned today in this video. Question number 1, what is a cash transaction? A business financial transaction which is settled immediately in cash is a cash transaction. Question number 2, what is a credit transaction? Credit transaction means when the goods are purchased now and they are promised to be settled at future date. Question number 3, what are the basic conditions for a transaction to classify as business transaction? Answer is four conditions needs to be fulfilled. Condition number one, two or more parties are involved. Second, there is an exchange of goods, services, or money. Third, transactions are measured in money terms. Fourth, the transaction is for and is related to the business. Question number four, what do you mean by the term account? Account is a summarized record of transactions of a particular head at one place. Question number five, explain the term capital. Capital is the amount invested by the proprietor, partner, or a shareholder in the business. Question number six, what is an accounting equation? Answer is capital is equal to assets minus liabilities. Question number seven, cash withdrawal by a partner should be recorded as a business transaction. Yes or no? Absolutely yes. It will be treated as a drawings by the partner and will get reduced from his capital in the business. Question number eight, whether capital is an asset or a liability of the business? It is a liability of the business. Please note down the topic, date, and the time for our next post. If you like the content and our way of explaining the topic, please do like and subscribe to our channel Accounting Buddy.